For years, crypto traders used to make a lot of money by doing one very simple thing, and that was plotting out the Bitcoin halving cycle, buying right before the halving date and selling 18 months after that. And anyone that followed this pattern, well, they got filthy rich. But in this cycle, there have been some radical changes to the market structure. And with these changes, there is a chance that the halving cycle may not even be relevant anymore. And if this is true, then any trader that is still relying on the halving cycle charts may actually get completely wrecked, because Bitcoin may actually be moving on something else completely. So in this episode, we're going to break it all down. How the halving cycle used to work, why it may no longer move markets, and if indeed it's not moving markets, then we need to explore what's actually moving the Bitcoin price today. Because if you're still watching the halving cycle to make your calls, you may be watching the wrong signal, and you may get your portfolio totally wrecked. So if that sounds good to you, obliterate the like button, subscribe to our channel, and let's get the show on the road, guys. Let's start with what the halving actually is, because a lot of people talk about it, but not everybody really understands it. Every 210,000 blocks, which is roughly every 4 years, the Bitcoin code triggers an automatic event that halves the rewards that the miners get for validating transactions. This means that the amount of new Bitcoin that enters circulation literally drops by 50% overnight. Now let's take a look at it. The reward started when Bitcoin launched at 50 Bitcoin per block that was mined, which meant that every time that a miner validated a block, they received 50 Bitcoin for validating that block. Then in November 2012, we had our first halving, and the reward dropped from 50 Bitcoin per block to 25 Bitcoin per block. Then in July 2016, there was another halving, and the reward dropped from 25 Bitcoin to 12.5 Bitcoin. Then again in 2020, the rewards halved again from 12.5 to 6.25 Bitcoin. And finally, after the most recent halving in April 2024, the rewards dropped from 6.25 to 3.125 Bitcoin for every block that's mined. So because of the supply shock, and because there were less Bitcoin coming into circulation, it meant that with the same demand, there was less supply. And that effectively triggered a supply shock, which triggered a bull market, or the bull markets that we're all familiar with. And for 3 full cycles, it worked almost perfectly. Let's take a look at the chart. In 2012, after the first halving, Bitcoin climbed from $12 to about $1,215 within 13 months. In 2016, post the halving, it ran from $650 to nearly $20,000 in less than 17 months. And then again in 2020, the supply shock came in again and increased the price of Bitcoin from $8,700 to nearly $69,000 over an 18-month window. Every single time, the market followed the same cycle. Accumulate before the halving and take profits about 18 months later. It became the go-to playbook in crypto. Our research shows that this cycle must be breaking down, and we are going to dig into why we think the reasoning for this. So let's start. Right now, there are about 20 million Bitcoin already in circulation. As we all know, the hard cap is about 21 million. So there's only 1 million Bitcoin left to be mined, and that makes up about 4.5% of the supply. What this means is that the incentives that the miners are relying on is shrinking, and the impact of the halving is actually getting relatively smaller every single time. Let me show you what that looks like with real numbers. Back in 2012, the miners were producing about 7,200 Bitcoin per day. That's 2.6 million Bitcoin per year. At the time, Bitcoin was trading at about $12. So the total value of the new supply was $32 million a year. Now remember, the whole market cap back then was only $130 million, which means that the number of new Bitcoin coming onto the market was equal to 25% of the Bitcoin on the market. And that's a huge number. By 2016, the issuance dropped to 3,600 Bitcoin per day, and the price was around $650. That means that 850 million Bitcoin entered the market each and every year, which is about 8% of the total market value. And in 2020, we were down to 1,800 Bitcoin per day. With an average price of 8,700, that's 5.7 billion in new supply annually, which made up about 3.6% of the market cap. But then, In 2024, after the last halving, miners started to produce just 900 Bitcoin per day. At $64,000, that's about 21 billion in new issuance. But that's against a $1.25 trillion market cap. And it's only a 1.67% inflation. And now, after the most recent halving, we're down to 450 Bitcoin per day. If Bitcoin's trading near $95,000, that's $15.6 billion in new supply per year. But against a market cap closing in on $2 trillion, it's less than 1%, just 0.83, from 25% inflation to under 1%. That's why halvings no longer spark the same kind of rally. The impact is just too small. Take a look at this chart. You can understand how that effect is now really negligible. And now that's not even the full picture. Zoom out for a second. There are about 4 million Bitcoin where the keys are gone forever. Lost keys, destroyed wallets, coins that are never coming back to the market. Then you've got the heavyweights. You've got MicroStrategy, 21 Capital. These guys ain't selling. In fact, they're buying, and they're not playing small.
You buy Bitcoin, you hold Bitcoin, you support the Bitcoin protocol, you do not sell your Bitcoin.
MicroStrategy alone today owns over 2.6% of the entire Bitcoin supply. That's over 500,000 Bitcoin. And the crazy part? They still have billions of firepower lined up through new equity raises. And MicroStrategy got authorized to additional $21 billion in common shares ATM. That can be sold directly at the market. That can easily add another 1% of the total supply. Also, now a lot of people are copying the MicroStrategy playbook. So you've got people like 21 Capital, which is backed by a team of pro-Bitcoin giants, Tether, SoftBank, and led by none other than Jack Mallers, who is the CEO of Strike. They have launched with over 42,000 Bitcoin already. That's about 0.2% of the total supply, instantly making them the third largest corporate Bitcoin holder in the world, right behind MicroStrategy. And they have been buying more. They recently bought around $500 million worth of Bitcoin, and they are planning to keep adding more to their treasury. When you zoom out and include all the companies following the same playbook and putting Bitcoin on their balance sheets and treating it as a long-term reserve, we're looking at a future where 10% or more of all Bitcoin could be locked away by corporate treasuries alone. So the conclusion is, they're not slowing down, they're doubling down. And that supply will never come back on the market. Now add in the governments. The US is sitting on over 200,000 Bitcoin, most of it taken from people over the years in different cases. And it will be part of their strategic reserve, which means they are not selling it.
And they made the promise, right?
Absolutely.
And other countries, they're watching from the sidelines. Quiet for now, but you can feel it. They're getting ready to follow. Add it all up, and more than 6.3 million Bitcoin is already off the market. That's close to 30% of the total supply. So it's not just about less new supply coming in. It's that a huge chunk of the existing supply is already being acquired and held, so it is basically out of circulation. Speaking of institutions, ETF flows have become a major signal. Since the launch of the Bitcoin spot ETFs, billions of dollars have poured into the ETFs. And this isn't degen speculation. This is long-term institutional allocation. Wall Street, they don't care about halving cycles. They move on macro conditions, rate expectations, and portfolio rotations. And they ultimately have two modes. They're either risk on or risk off. And right now, Bitcoin is considered a risk asset by most institutions. It reacts to interest rate moves, inflation prints, and macro sentiment. In fact, in many ways, it still mirrors the NASDAQ. Let's look at this chart. This chart shows the correlation between Bitcoin and the S&P 500. And you can see that from mid-2024 until now, Bitcoin has been mirroring the S&P, which proves the point that by institutions, Bitcoin is treated as a risk asset. Now look at gold. Gold rallied during global stress, trade wars, inflation, geopolitical tension. And Bitcoin? It rallied on ETF inflows and adoption. Two completely different narratives, but they're slowly converging. Because as more institutions start treating Bitcoin like a reserve asset, and as more countries start putting Bitcoin on their books, the supply keeps tightening. And Bitcoin starts acting less like a trade and much more like a digital gold. And here's something else the old school halving crowd might be missing. Bitcoin isn't just maturing on paper, it's showing up in the numbers. Since 2021, Bitcoin's realized volatility had a sharp drop. It used to swing 80 to 100% on a 180-day basis. Today, it's sitting around 55 to 60%. That's right in line with tech giants like NVIDIA. Not meme coins, not startup stocks, but real companies. And its market beta is shifting too. For the majority of 2024, Bitcoin had a beta of over 1.5, which means that when the S&P moved 1%, Bitcoin moved even more. That's what made it such a high beta play. But now, that beta's creeping lower. It's still a risk-on asset, yeah, but it's reacting less to every twitch in equities. It's slowly starting to act like its own thing. That's what maturity looks like on a chart. So, the question becomes, if halvings aren't moving the price anymore, and now Bitcoin is being treated as a risk asset by institutions, then what is the price actually moving on? Well, it's one word: liquidity. Take a look at this chart. Before 2024, there was no real connection between Bitcoin and the global M2. They moved on totally different tracks. But once the institutions started piling in with the ETF, something changed. And since then, Bitcoin has been moving in total sync with the money supply. There's a bit of a delay, about 90 days, but the pattern is clear. When liquidity goes up, Bitcoin goes up. And when liquidity shrinks, Bitcoin pulls back. This didn't exist in earlier cycles. But the good news? Well, we're going into a high liquidity cycle. We contracted from the start of 2025 until April, but starting from April, the M2 money supply has been expanding. Let's bring it all together. Bitcoin used to move in clean 4-year cycles. First, supply cuts, then halving hype, and then a price explosion. But we might be losing pattern because the impact of the new supply to the total supply have become almost negligible. Only 4.5% of Bitcoin is left to be mined. Also, on top of that, almost 30% of the total supply is already acquired and being held, so halvings just don't hit the same when the supply shock barely moves the needle. So what's actually moving the price now? It's liquidity, global capital flows, institutional demand. So Bitcoin is no longer riding on just retail hype or mining rewards. It's moving with the money. And the money? It's coming from the big boys. Since 2024, Bitcoin's been shadowing global M2 with a really noticeable precision. Not by chance, but because the market matured. Institutional adoption flipped the switch with the ETFs giving access, and treasuries started allocating. This isn't the same Bitcoin market we knew in 2017 or even 2021. It's bigger, smarter, and deeper. Volatility is coming down while correlations are changing. And Bitcoin's market beta? It is sliding lower. It still trades like a tech stock, but it's acting more like a new asset class. It's a mix between a tech stock and gold. And right now, lucky for us, the money cycle is expanding. This is a clear sign that in the long term, Bitcoin will carry on moving up. So, if you are one of the traders that's still trading on the halving cycle, you may be getting wrecked. Bitcoin's not just growing up, it's already grown. So here's the takeout. If you're serious about timing Bitcoin's moves, stop watching the halving countdown. Watch liquidity. Watch M2, because that's what drives the market for now. Follow the market supply. Follow macro trends and stay informed, and you'll be ahead of 90% of the market that's still stuck staring at the halving calendar. And if that shifted your perspective, hit the like button, subscribe to the channel, and I'll see you in the next one. Until then, trade well, my friends.